Welcome back to the podcast. Ernest, we got a packed show today. We got a lot of topics we want to hit. So pretty exciting stuff for us. Hope you find it exciting, and we always appreciate all our listeners. Please leave us a 5-star review if you can on any of the platforms where you find our podcast. We really appreciate it. And let's get into it. First topic is buybacks. Have we ever talked about buybacks, the power of compounding through buybacks on this show before?
Well, I think buybacks are, one of those things that a lot of people hear about on the media, but maybe aren't really sure about what exactly they mean.
All right, well, let's quickly discuss what is a share buyback. What is the aim of a share buyback? Go ahead.
So a share buyback is when a company, simply put, buys back its own stock. So they go into the market. There's various mechanisms for this, but they go into the market and they buy back their own stock. In Canada, the shares are immediately canceled. Mm-hmm. So if I don't know, let's say TD Bank decides to buy back a stock, then there's one less TD Bank share outstanding.
That's right. So if it had 20 shares outstanding and it buys back one, it now has 19 shares outstanding, and
the proportionate share of all the other shareholders goes up of TD Bank.
Correct. So very interesting how a buyback works. Of course, we have a lot of companies in Canada that we call serial buybackers, where they buy back a share of their stock every year. There are pros and cons to buybacks, of course. Many reasons why you should buy back your stock versus maybe paying a dividend or making acquisitions. Just like a regular investor, if you think the stock is cheap and you think it's a good investment, then management should act like an investor and buy back a share of its stock if it can. The problem, of course, companies run into with buybacks, Ernest, is sometimes they use debt or leverage to buy back shares instead of actual cash flow. So it may feel good to buy back the stock at a cheap price and maybe even boost earnings, but you're putting a liability on the balance sheet as a result, right? Sometimes you'll be buying back shares and your company is not showing any organic revenue growth. Maybe its business is in a terminal decline. So you're buying back today's share price, but the future of your business doesn't look so good. So that may not work out very well. And of course, you may be in a very cyclical or commodity sensitive business. And when the price of that commodity is doing great, you're flush with cash, you're buying back stock. It feels great, but then all of a sudden that commodity goes down in price, and your share price goes down in price, and you don't have any cash flow to buy back your stock when you should be when the price is down. So your feelings about buybacks, the pros and cons.
Right. So share buybacks are basically just another way of returning capital to shareholders. Most people consider buybacks to be a more tax efficient way of capital returns relative to dividends, because if you're buying back a stock, it's tax-free. There's no tax consequences to it. It is the buyback is done using after-tax cash flow at the corporation level, and your share of the company, if you don't sell, goes up after the buyback.
Not everybody wants the dividend, right? So if I get a dividend from TD Bank, I may not want it. I may not need it. But you know what? If it goes into a taxable account, I'm taxed on that dividend. And then I have to come up with money later for the tax on that portion. Whereas if TD buys back its stock using its own free cash flow, I'm not impacted. I don't have to come up with any tax to pay for it later. Presumably, though, that would boost the share price over the long term. So maybe I would pay a higher capital gain in the future if TD does its buyback correctly.
I think the reason why some investors maybe frown upon buybacks relative to dividends is because buybacks allow for a little bit more shenanigans.
Yeah.
They can, for example, do a company that does a buyback would increase earnings per share. So if there's a CEO whose bonus is tied to earnings per share growth, then a buyback would help that objective more than a dividend.
So let's talk about that. So if you had $2 a share of earnings or $20 a share of earnings and you had 20 shares outstanding, then your earnings per share is $1. 20 divided by 20. If you had 10 shares outstanding, 20 divided by 10 is $2. So it automatically, the more you buy back, the more it boosts your earnings, and everything else held equal. If your stock is trading at 20 times earnings and you earn $1 a share, the stock should trade at $20. If you earn $2 a share, it should trade at $40, right? So the more you buy back, the more you could boost your earning and your share price.
Yes.
As per your discussion. Yeah.
And the problem with that is that may not necessarily be in your best interest, because in this specific scenario, what the CEO is concerned about is not that they're making a smart investment decision, but that his bonus is going to be higher.
That's right.
And
so there are a lot of companies where the CEOs and management team are compensated by earnings per share and share price movement instead. Yeah,
exactly. So that's one of the downsides of buybacks. I think another thing that can happen with buybacks is that sometimes companies can do buybacks and allow large investors to sell into the buyback, basically providing liquidity for a large shareholder. And that's not really what you would want the company to be doing with its resources.
So what's the ideal circumstance where a company would be buying back its shares? Where would it make a lot of sense in your opinion, Ernest?
So the only reason why a company should be repurchasing stock should be because it thinks that the shares are an attractive use of capital relative to all the other alternatives. So one company that I think does a really intelligent job of doing buybacks is CCL Industries that we've talked about, the labeling company.
Yep.
And so at CCL Industries, when they're generating excess cash flow, they can pay dividends, which they do. They can make acquisitions, they can pay down debt, and they can do buybacks. They usually have historically done acquisitions paying about a 6 or 7 times multiple for these deals.
6-7 times earnings or whatever multiple.
EBITDA.
Yeah.
And so if it's going out and buying back its own stock at 9 times EBITDA, then they're paying a high,
makes no sense.
That doesn't make sense, right? They'd rather keep the cash to make acquisitions because they're going to earn a greater return on that.
Yeah.
But then on very few occasions, CCL's stock price falls below that.
Yeah.
And that's when they buy back stock because it's a better use of capital than making acquisitions. And so that's exactly, I think,
the intelligent thought process of buying back shares. When your share price is cheaper than what you can acquire, you should do it. Now let's talk about a company that is going full bore on share buybacks, which is Canadian Natural Resources, CNQ. I have a list here, Ernest. I asked Ernest this morning, send me a list of all the companies that have bought back their shares over the last 3 years. Who's been the biggest? And number 1, number 2 is 3 is Imperial Oil, CN Rail, and Canadian Natural Resources. Imperial Oil and CNQ are quite similar businesses, right? Significant portion of their assets in oil sands and long life reserves, right? So commodity sensitive business, no control over the commodity price, but these companies already have nice sized dividends, so probably no reason to raise the dividends. Does it make sense for CNQ and Imperial Oil to spend $4 to $5 billion a year on buybacks like they've done in the past?
So the trap for many commodity sensitive businesses is that most of the time when these companies are making a lot of money, that's because the commodity price is high.
Yeah.
And so that's not historically, if you believe that commodity prices go up and down, you don't necessarily want the companies to be buying back stock at a time when commodity prices are likely to fall.
Yeah.
And history has shown that to be true. Most companies, many commodity businesses, they do buybacks at the wrong time.
Yes.
They buy back stock when the commodity price and their share price is high, and they have to issue stock conversely when at the worst time.
Yeah.
So, but I think in the case of Canadian Natural and Imperial Oil and Suncor, I think it's a little bit different. First of all, these are extremely long-lived assets. So based on current production levels, I think Canadian Natural has over 50 years worth of oil.
Yeah.
So in essence, it's a royalty business because they're going to be extracting oil here for till the end of time, and they have no need for additional capital. The oil's already there. So that's the first thing. And then second is that to the extent that you believe that oil prices, especially heavy oil prices in Canada, are going to be supported by the pipeline projects that are coming on board, there's reason to think that fundamentals will be solid going forward.
Plus production growth, right?
Exactly.
Yeah.
And in the case of something like Canadian CNQ, they're making so much money at current oil prices. They are paying dividends, and they've publicly been said that after they pay down debt to a reasonable level, which they have, they're going to be finding the best way to return stock. And with something like CNQ, you have Anne-Marie Edwards. Most of his wealth is in this company. If he's buying back stock, that clearly he thinks it's a good idea.
One of the things we love about CNQ is the fact that it considers its dividend, its set dividend, as a capital expenditure, right? It feels that free cash flow is after paying its dividend, and no other company does that.
Right.
And so that gives you at least the comfort level that that dividend is not going away unless oil prices go to zero and stay there. A final company that we want to talk about is Couche-Tard. Maybe we'll just get right into its earnings. Sure. But it's also been a serial buybacker and just announced recently that it plans to buy back 10% of its shares. Just because a company announces to buy back 10% doesn't mean it's going to do it, right? It's not like they're paying a dividend or buying back stocks, no guarantee. But why does it make sense for Couche-Tard to buy back its shares? It's there's no recurring revenues. No one's forced to go into its convenience stores and buy gum or cigarettes or a hot dog or a Twinkie. But people still have to go to work every day, fill up their car with gas. So does it make sense for buybacks to happen in this business?
Well, to your point, first of all, to your point about the buyback authorization, is that there are certain rules that the TSX exchange sets in terms of how companies are allowed to conduct buybacks. And so my understanding is that for regular normal course issuer bid buybacks, which is the normal program that companies conduct buybacks under, you have to renew this every year. So to the extent that you announced that you're going to do 10% this year, and then next year, let's say you only did 7%, then you'd have to go to the TSX and tell them, okay, we want to do another 10%, right? And then you renew the buyback, and then that gives, that's how the rules work.
You can't just say you're going to buy back stock. You have to let the public know.
Okay. And there's certain parameters around like how you're allowed to buy back stock so that to ensure that you're not manipulating the share price. But then with Couche-Tard in particular, I think one of the situations that I really like to look at when looking for companies that buy back stock is companies that have significant insider ownership, and which is definitely the case with Couche-Tard. The reason that this matters is because when you have a company where the insiders are owning the majority of the stock, they already have most of their wealth invested in this company. And
they would love to get a dividend, right? Because it goes right to them.
Yeah. And so if they are doing a buyback and they're not selling into the buyback, that means that they think that they want to be increasing their ownership of the business.
Very good point.
And so in the case of Couche-Tard, the stock has been fairly weak for a little while for a variety of reasons, which we'll get into later. But I think the company clearly feels that the share price is undervalued and that buying back stock is a good use of capital.
And to finish off the buyback conversation, because it's getting long in the tooth, is it compounds value over time if done correctly. As I mentioned, you heard me say that if you're 20 shares outstanding and it goes down to 10, automatically their earnings double. And if you get the same multiple, the share price doubles, right? But you're not going to buy back 50% of your shares in 1 year. You're probably going to buy, if it makes sense to buy back stock and you're a serial buybacker and do it over several years, it might take 8 to 10 years to buy back 20 or 30% of the stock. But if your business is still growing, you're doing M&A. These things add to the earnings power, and all of a sudden you can wake up and find that the company that was doing $1 per share of earnings 10 years later is now doing $3 per share of earnings. And some of that is as a result of buybacks, some as a result of organic growth, some of that is a result of M&A. So those are just powerful tools to grow earnings and grow your investment dollars, and that's what we're looking for.
Well said.
Okay, so Couche-Tard, just for those that have been following our podcast, stock that we've been following for a long time. We bought it earlier this year. I guess we bought it into a little bit of temporary issues. Hopefully they're temporary issues. The stock has held up okay since a purchase for ourselves and our clients, but clearly pressure, Ernest, from the consumer, as well as fuel margins under pressure. So talk about what is going on with Couche-Tard, and new CEO just announced. So
That's right.
Let's talk about the pros and cons.
So Couche-Tard announced earnings, and they were not great. They are impacted by a variety of things. Number one is that, especially in the U.S., a large portion of their consumer base skews lower income. And what we've seen from the commentary from like fast food companies and Walmart and these kinds of businesses is that lower income consumers are not doing well. Like they're
hurt the most by inflation.
They're hurt by inflation.
Yep.
There's been some pullback of government incentives, and so they're driving less and they are spending less when they go into stores. And when they are spending, they're trading down. Yeah. So previously they might be buying like premium beer. Now they're buying like domestic light
Pabst
beer.
Blue Ribbon.
Yes.
Yeah.
So that's one of the things that's impacting Couche-Tard. The second thing is that fuel margins, so the amount of money that they make when you're filling up, that has fallen by a little bit as well.
Yeah.
They have gone up quite strongly during the last couple of years. And the reason why fuel margins have fallen is because there hasn't been a lot of fuel price volatility. So the way that prices at the pump work is generally there's a very sophisticated trading operation that goes behind what you see. And when fuel prices are volatile, they make more money because they're able to arbitrage the price differences between where they buy and where they sell it. And so over the last couple of quarters, prices have been fairly stable. So not a lot of opportunities to make money.
Yeah, if people remember, and during the pandemic and just prior to it, oil prices went from like $80 a barrel to negative, stuck around 20, then flew back up to 100 because of the Russia-Ukraine start of that war, and then they've been pretty stable since, right? So there was a crazy amount of volatility, and of course, where do you get gasoline from? Get it from oil. And so more recently, Ernest, the past 2-3 years, oil prices have kind of stuck around the $70 to $90 a barrel. So I assume that has impacted the volatility in gasoline or fuel prices.
That's right. No, I think the long term for fuel margins is still quite positive because the cost structure of independent gas stations continues to go up. And so that's been a driver. That's been the driver of fuel margins over the long run, and should continue past this episode. So
how is Couche-Tard going to rectify this issue with low income families being affected? Because even if inflation cools off, all right, it's still, the prices aren't going to be rolled back that much. We have seen some announcements by McDonald's and restaurant brands that owns Burger King and Popeyes that they're introducing value meals. So, that there could be some discounted prices, but the price of cigarettes have gone up a lot, especially in Canada. The prices of alcohol, of soft drinks, they're not going to come down. So how do they drive people back to the stores?
Well, the reality is that there's not very much that a company like Couche-Tard can do to drive traffic in the near term. Mm-hmm. This isn't like Starbucks where you can, turn on the loyalty program and add promos and get people to go in. Mm-hmm. This is convenience. This is a convenience location. Yeah. The whole point of convenience stores is that they're convenient and that you drive by and you want to buy something. Yeah. So what Couche-Tard is able to do is that they're leaning into their loyalty program and increasing the offers for some of their most popular items. So for example, they announced a promo where you can buy slushies of any size for 79 cents.
I haven't bought a slushie since I was 12 years old, riding my bike to Becker's. You remember Becker's?
Yes.
Yeah. So, good for them.
So
I hope that drives some traffic.
And so by doing that, the hope is that you'll go in, you'll buy that slushie, and maybe you'll buy a pack of chips or something else as well. And so that another thing that they're doing is that they are leaning into marketing for their alternative tobacco, things like vaping, right? These are things that it's a very important channel for people to buy these things. And so they are really, developing special offers for people to go in and spend more on.
So it's going to take a couple of quarters to really renew same-store sales growth. In the meantime, Ernest, Couche-Tard is by far one of the best operators. Even though they've been struggling with top-line sales recently, they've kept costs extremely tight, and that's why they're generating so much free cash flow even in a tougher time. Now, keep in mind, things are tough versus where they were, but still on the right trajectory over the last few years.
Right, and I think the silver lining on this tough environment is that everybody is suffering to some extent. And so what Couche-Tard is seeing is that, I think they said on the call, that the pipeline of potential acquisitions that are available at attractive prices is as good as it's been for a while. And so we'll probably see some more deals.
Nice. And so Couche-Tard is a great operator, great acquirer. They announced, as we said, this buyback. They raised their dividend 25%. New CEO, anything to say there?
Yep. So I think that was a bit of a surprise because Brian Hanesh,
the current CEO, he's only he came as part of an acquisition they made in the U.S. when they first pushed into the U.S. He just recently announced a new 5-year strategic plan at the Investor Day. Yeah.
So it's a bit of a surprise that he was stepping down now
and not following through with the plan. Yeah.
But I think he said on the call that he was 58 years old, wanted to spend more time with his family, and each to their own.
He's not leaving Couche-Tard, by the way. He's going to remain a special advisor to the president.
Focused on M&A.
Yeah. So looks like he does. You never know people's motivations, and running a publicly traded company, one of the largest in Canada, is stressful. I can imagine, right? Running a $50+ billion U.S. market cap company. And he's been doing this, probably working for 25+ years or whatever, the amount of years, and 10 years. How many years at Couche-Tard as CEO?
Don't have that off the top of my mind, but
what? I think 10 years.
Yeah, something like that.
Yeah. So anyways.
Maybe his wife didn't want to live in Quebec. I don't know. Who knows?
Well, the good news is the new CEO is much younger and has lots of experience at Couche-Tard. He was a CFO?
So he was the CEO. So the new CEO will be Alex Miller. He joined as, he's been at Couche-Tard since 2012. He's done a variety of roles there, and he's currently the COO, current Chief Operating Officer. And so he'll probably be
CEOs are really the next in line to become CEO. CEOs, Chief Operating Officer, tends to run the business, tends to do more of the day-to-day grunt work, but generally great people to promote and have been mentored and probably understand the business fairly well. So we're excited about the Couche-Tard. I mean, this is what happens in companies. We're long-term investors. I don't think anything has changed in our long-term thesis with Couche-Tard. In fact, maybe things are even better if you think that they're going to turn on the buyback and the stock price hasn't done anything over the long term. Isn't that what you want, Ernest? A company to buy back its shares today at lower prices and in the hopes the future will be better?
What is interesting is that the conversation about electric vehicles has totally dried up.
Okay.
It's not even a topic that comes up on earnings calls anymore. And I think that I think that's a good thing for Couche-Tard because it's an important transaction. It's an important part of their business. And so to the extent that electric car penetration is slower than usual, that's a good thing in the long run.
I still don't understand why, even if you have an electric vehicle, why you wouldn't stop at a convenience store if you needed.
Well, you do. That's the point.
That's the point, right? You're going to stop. Your kids are going to get hungry on a drive. You're going to still, maybe if you smoke cigarettes, you drink alcohol, I don't know what it is. You still just because you've switched from a gasoline car to an electric car doesn't mean you're not going to stop at these convenience stores.
And you'll be able to buy beer in convenience stores in Ontario.
So that should help some going forward with Couche-Tard. Might see a little bit of boost. All right, let's move along from Couche-Tard to talk about the TMX Group Investor Day. TMX Group, Ernest, this is a stock that we've owned for clients since 2015, and it's done a great job of pivoting its business. For those that don't follow TMX Group, it owns the number of exchanges in Canada, the Toronto Stock Exchange, the Montreal Exchange, which is now a derivative exchange, the TSX Venture Exchange, and the exchange business has been very quiet the last few years. I can't even name one new public offering in Canada over the last 5 years. Can you?
In 5 years, yes.
Name one.
There's been
GFL, the garbage company, maybe.
5 years is a long time. There's been like Lightspeed Commerce, a bunch of smaller companies.
But nothing huge or material, nothing that, whereas in the US, there's new IPOs, there's new public offerings every day of significant companies. And so it's been quiet. And so I think TSX has recognized that. And over the last 10 years or so has pivoted its business more toward recurring revenue, information, data companies. So talk about what you learned from the Investor Day.
Can I make a side note?
Nope.
No.
Okay, you can. Fine.
Okay. So to the point about the IPOs is that one of the things that's happened over the last couple of years, mainly last 2 years, is there's been a lot of takeovers, private equity takeovers of these smaller tech companies that have IPO'd on the TSX.
There's been a lot of takeovers, yeah.
At premiums that are not, like they would announce like a 30% premium or 50% premium. Stock would pop up 50%, but still be 80% below where they traded in 2021, where the stock probably IPO'd.
You're thinking of a company like Nuvei or
Yes.
that just got acquired.
There's quite a few of these. I think I don't know what the TSX can do about it. I think it's a bad thing for the capital markets in general, where you have a situation where a company sells shares to public investors at a high price, stock plummets 80%, and then gets taken over, going back private often by the same shareholders that took it public in the first place at a significant discount.
And we've seen a number of those type of takeovers. So I can't recall the names, but I've seen many of them.
I think it's bad for the capital markets in Canada, and I think it's not good. It's not conducive to a supportive market for investment.
It feels kind of like a Ponzi scheme, right? Where everybody piles into these stocks when they go public to push them up for unwitting suckers to buy them, thinking they're going to be the next Shopify. They're not. These stocks get crushed, like you said, and then hey, we can buy them back or private equity because they're still good enough businesses. Is it just the fact that we just don't have a good enough venture capital system? We don't have sophisticated enough investors? Is it a cowboy mentality? Like, why does this exist?
Well, I mean, like, I'm sure in the US this happens as well.
I'm sure.
But maybe some of these, I think maybe it's on a smaller scale and a little bit less public.
Yeah.
Because there's a lot more companies in the US. But
well, Ernest, this is capitalism, and you have to take the good with the bad.
Exactly.
Yeah. So okay.
Anyways, back to TMX Group. TMX Group, I think we own the stock since 2015.
Yep.
It has exceeded our expectations.
Yeah, the stock has doubled over the last 5 years. I just looked the other day before dividends. I mean, can't cry about those returns. That's what we're looking for. We're looking for companies that can deliver our clients double-digit total returns per year over the long term, and TMX has done extremely well.
And I think the initial thesis all along for TMX Group was that it was an exchange company that traded at a discount to U.S. exchange peers, such as, so think of companies like CME Group or NASDAQ or Intercontinental Exchange, these kinds of businesses. And for most of TMX's life, it actually did. It traded at, I don't know, 15, 16 times
That
earnings.
was my thesis when I bought, well before you started here. That was our thesis. Good business, recurring revenues, high margins, nice dividend yield. Do we really need another bank in the portfolio? And it's such discount to the US exchanges and the international exchanges. Maybe someday someone will acquire it. Someone did try to acquire it. The London Stock Exchange did make an offer, but it didn't work. I think Canada did not allow that acquisition, worried about hollowing out of our great companies.
So today, TMX Group actually trades at a premium to US exchanges.
Even the NASDAQ?
Maybe. Possibly.
Yeah.
I think
But
it
overall,
does. Yeah,
but
overall, it does. And the reason for that is because they have successfully diversified their business mix into analytics.
Yeah.
So if you think about the types of financial companies out there, there are analytics companies like MSCI, which we just talked about a couple of weeks ago. There's companies like S&P and Moody's, and these businesses trade at a high multiple relative. They trade at high multiples because they are asset light, recurring revenue, pricing power businesses.
Yeah. So Thomson Reuters, which is now the fourth biggest company in Canada, I can't believe it. You and I were looking at it yesterday. I think it trades around 35 times earnings. Moody's, a company that our clients own, 35 times earnings. MSCI, a little bit lower, but has traded at 1.50 times earnings. FICO, which provides data, 45 times earnings.
Right.
So these companies get big, fat multiples. Here's TSX trading around 21 or 22 times earnings.
Right. And so analytics today makes up for like a little under half of TMX Group's revenues.
Yeah.
And this is the good stuff. This is recurring revenues that grow at double digits. Doesn't have it's diverse customer base. They have pricing power. Yeah. There's some secular tailwinds that it participates in. That's the good stuff. And then you still have the exchange business, which is kind of a low growth, mature listings business that probably trades at what TMX used to trade at.
So the listing business, it charges essentially rent to companies that list on the TSX. So Shopify lists its shares on the TSX. It doesn't want to list its shares on a small exchange or an exchange where no one has access to. You want the TSX if you're going to remain in Canada, and it pays rent every year based on the size of its market capitalization, correct?
Yes.
Okay.
And so the big story for TMX Group, which was expanded on during this investor day, is their journey towards analytics, which is mainly comprised of the acquisitions of Trayport, and the acquisition of Verify. And those businesses outgrow the rest of TMX Group, which they will, then you should see a valuation lift for TMX Group overall.
Yeah.
And I think they're continuing to look for acquisitions as well. Like we'll see what they do, but I think that they've done a terrific job of executing on this shift towards recurring revenues. The way that the CEO described it at the beginning of the presentation was that TMX Group is transforming from an infrastructure company to an information company, which explains everything that you need to know about the business.
Yeah.
And so we own it. I think they've done a terrific job, and we continue to hold the stock.
Yeah, I think, and the company really laid out a nice plan of how they're going to get there. They made this acquisition of Verify, which is a company that helps exchange-traded funds set up operations. People think that exchange-traded funds are going to continue to take more market share from mutual funds, and they're so easy to build, and you can use creative strategies to set them up, that the sky's really the limit in that business. And I can't remember where I'm going with this, but the bottom line, Ernest, is if they're able to grow that analytics business faster, and if listing business does pick up, I mean, we've had commodity prices have been stronger recently. Maybe we'll see some new listings of mining companies. TSX is also actively pitching companies in other countries to try and get them to list on the TSX. I don't know why they would or wouldn't, but they're trying very hard. If you got a pickup in the listings business and growth in the analytics business, I think you could do really well on the stock from here.
Right.
I think that's enough for today. Yeah, anything else you want to hit on?
No, I I'm reading a book right now about Rogers, the whole story between where Rogers did successfully acquire Shaw.
Yeah. And the family infighting that happened
Yes.
as a result. Ooh, it sounds juicy. Is it a good book?
I just started the book.
What's it called?
Don't remember the name. I'm gonna have to post it in the show notes.
I've seen that book. I don't remember the name either, but it's an in-depth tell-all story of the acquisition of Shaw, and the family kind of broke up, the Rogers family, as a result of this acquisition.
Yes, certainly. The telco space in Canada is going through some interesting changes, to say the least.
That's right, and so we'll be waiting for you to get more deep into the book to share all the juicy details, because that sounds like an exciting one to learn about. So we'll see you back here real soon, and thank you so much for joining us. Have a great day.